On January 30th, 2026, at 2:47 p.m. Eastern Standard Time, silver crashed 30% in a single trading session. The drop was the worst since March 27th, 1980. 46 years. That's how long it took for a single-day collapse this violent to happen again. And if you think this was market forces, supply and demand, natural price discovery, you're not paying attention. Because what happened on January 30th wasn't a crash. It was an execution. A deliberate, coordinated kill switch activated by the same institutions that control every major market on Earth. And the weapon they used? Margin requirements. But here's what nobody's telling you. The crash wasn't designed to protect the market. It was designed to protect the banks. The same banks that are short hundreds of millions of ounces of silver they don't have, can't deliver, and we're about to default on. This is the story of how Wall Street pulled the trigger, how they've done it before, and why silver dropping below $74 today isn't the end of the story. It's just the beginning of a war between paper and physical that's been building for 50 years. And when you understand the mechanism, when you see how the kill switch actually works, you'll realize something terrifying. They can do this to any market, any asset, anytime they want. Let me show you exactly what happened. The setup, how silver hit, $120, and why that terrified Wall Street. To understand the kill switch, you need to understand what was happening to silver in the weeks before January 30th. This wasn't a gradual rise. This was a parabolic moonshot. On January 1st, 2026, silver was trading at $70 per ounce. By January 27th, it had hit an intraday high of $121.47. That's a 73% gain in 27 days. For context, the S&P 500's entire 2025 return was 26%. Silver did almost 3 times that in less than a month. What caused it? 3 forces converging simultaneously. First, China implemented an export licensing system for critical minerals on January 1st, 2026. Silver was on that list. China produces 20% of the world's mined silver and refines 70% of global supply. When they announced export restrictions, they didn't just limit supply, they created a physical shortage. Overnight, industrial buyers in the US, Europe, and Japan, who depend on Chinese silver for solar panels, semiconductors, electric vehicles, AI data centers, they all panicked. They stopped buying paper contracts. They started demanding physical delivery. Second, the structural deficit. Silver has been in supply deficit for 6 consecutive years. Demand is 835 million ounces annually. Mine production is 680 million. That's a 155 million ounce shortfall every single year. Where does it come from? Recycling, scrap, and existing inventory. But here's the problem. COMEX registered vaults, the physical silver backing futures contracts, had fallen to 113 million ounces by January 2026. That's the lowest level in 30 years. Third, the short squeeze. Wall Street banks, JP Morgan, Goldman Sachs, HSBC, they've been short silver for decades. They sell futures contracts, paper promises to deliver silver without holding the physical metal. This keeps prices suppressed. It's worked for 50 years. But in January 2026, something broke. Industrial buyers started standing for delivery, taking physical silver off the COMEX, draining the vaults. And when you're short 200 million ounces of paper silver, but only 113 million ounces of physical exists in the registered vaults, you have a problem, a terminal problem. By January 27th, silver lease rates, the cost to borrow physical silver, had spiked to 31% annually. That's not normal. That's not a functioning market. That's panic. Banks were scrambling to find physical silver to deliver against contracts. They couldn't. Prices went vertical. And that's when the kill switch was activated. The weapon? CME margin. Hikes and how they destroy leveraged positions. The Chicago Mercantile Exchange, CME Group, is the world's largest derivatives marketplace. They operate COMEX, where silver futures trade. And they have one power that supersedes everything else. The power to change margin requirements instantly, without notice, at any time. Margin is the deposit required to hold a futures contract. For silver, one contract represents 5,000 ounces. Before January 2026, the initial margin was $22,000 per contract. That's $440 per ounce. You could control $350,000 worth of silver with $22,000 in capital. That's 16-to-1 leverage. This leverage is what allows speculators, hedge funds, retail traders to participate in the market. But it's also what makes them vulnerable. Because when prices move against you and your account equity drops below the maintenance margin, you get a margin call. You must deposit more cash or your position is liquidated, forced selling. Here's what CME Group did. On December 26, 2025, they raised silver margins from $22,000 to $25,000, a 13.6% increase. Silver ignored it, kept climbing. On December 30th, they raised it again to $32,500, a 30% increase in 1 week. Still, silver climbed. Hit $84 on December 29th. Then on January 7th, 2026, they changed the game. They shifted from a flat dollar margin to a percentage-based system. Initial margin became 9% of the contract's notional value. When silver was at $70, that's $31,500 per contract. When silver hit $120, that's $54,000 per contract. A 72% increase in 3 weeks. But they didn't stop. On January 28th, they raised it to 11%. On January 30th, to 15%. For high-risk accounts, 16.5%. Let me translate that. On January 1st, you could hold a silver contract with $22,000. On January 30th, with silver at $100, you needed $75,000. If you didn't have it, your position was liquidated, forced selling at market prices, during the fastest price collapse in 46 years. This is the kill switch, not a natural market correction, a mechanical liquidation event engineered by changing the rules mid-game. And here's the critical detail nobody's saying out loud. CME Group isn't a neutral regulator. It's a for-profit corporation, ticker CME. And its clearing members, the entities that guarantee trades, are the very same banks that are short silver: JP Morgan, Goldman Sachs, HSBC, Citibank. The conflict of interest is structural. If the banks default because they can't deliver physical silver against their short positions, CME is on the hook. So CME changed the rules to protect the banks. They raised margins so aggressively that it forced speculators out of the market, crashed the price, and gave the banks breathing room. This isn't theory. This is exactly what the margin notices said. Managing risk to the clearinghouse. That's code for protecting short-positioned banks from defaulting. And here's proof it worked. On January 30th, silver dropped from $100 to $78 in 6 hours, a 30% collapse, the worst since 1980. But while paper prices in New York were crashing, physical premiums in Shanghai and Dubai surged $20 above spot. Physical silver was trading at $98, while COMEX futures were at $78. That disconnect, that $20 spread, is the smoking gun. It proves the paper market crashed due to forced liquidation while physical demand remained strong. The kill switch didn't fix a bubble, it detonated one to save the banks. The precedent: 1980, the Hunt brothers, and the original kill switch. If this feels familiar, it's because it's happened before, exactly this way. Same mechanism, same players, same outcome. March 27th, 1980, Silver Thursday. Silver dropped 50% in a single day, from $21 to $10. The story you've been told is that two Texas billionaires, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They bought 195 million ounces of physical silver and silver futures. By January 1980, they controlled 1/3 of the world's deliverable supply. Silver hit $48.70 per ounce, then COMEX changed the rules. On January 7th, 1980, they implemented Silver Rule 7. It restricted the purchase of silver on margin. Liquidation only, no new long positions. The Hunt brothers had borrowed heavily to finance their purchases. When the rule changed, they couldn't roll their contracts, couldn't meet margin calls, their positions were liquidated, silver collapsed. They lost over $1 billion, declared bankruptcy, were convicted of market manipulation. That's the story, but it's incomplete because the Hunt brothers didn't drive silver to $48. They contributed maybe $1 per ounce, according to Jeffrey Christian, one of the world's leading silver analysts. The real driver was ordinary investors fleeing the dollar. In 1979, inflation was 13%. The dollar was collapsing. Gold and silver were the only stores of value that worked. Global demand surged. Everyone wanted physical. The Hunt brothers just got blamed because they were visible, wealthy, and easy to scapegoat. But here's what matters. COMEX changed the margin requirements to crash the price. They used the same kill switch, and it worked. Silver went from $48 to $10. The Hunt brothers were destroyed, and the banks, who were short silver and couldn't deliver, were saved. Fast forward 46 years, January 30th, 2026, same playbook. Silver hits $121. Industrial buyers demand physical delivery. Banks are short and can't deliver. CME raises margins repeatedly, forces liquidation, crashes the price 30%. Banks are saved. History doesn't repeat, but it rhymes. And the rhyme is deliberate. The disconnect. Why physical silver traded $20 above paper during the crash. Here's the part that destroys the official narrative. On January 30th, while COMEX silver futures were crashing from $100 to $78, physical silver in Shanghai was trading at $98. In Dubai, $96. In London, $95. That's a $20 premium over the paper price. That should not exist. If the crash was driven by fundamental supply-demand factors, physical and paper prices should move together. But they didn't. Why? Because the crash was mechanical, not fundamental. COMEX forced speculators to sell futures contracts, paper selling. But physical buyers didn't panic. They kept buying because they need the metal. Solar manufacturers need silver for panels. Semiconductor fabricators need it for chips. Electric vehicle makers need it for electronics. AI data centers need it for servers. These aren't speculators. They're industrial consumers. They don't care about futures prices. They care about securing physical supply. And when they saw COMEX prices crashing while physical supply remained tight, they bought more. This created a bifurcation. The paper market, dominated by leverage and forced liquidation, collapsed. The physical market, driven by actual supply demand, stayed strong. This disconnect is the proof that Wall Street's kill switch doesn't reflect reality. It manipulates perception. By crashing futures prices through margin hikes, they create the illusion of a market correction. But the physical premium reveals the truth. Real demand is strong, real supply is tight. The paper crash is artificial. And here's why that matters. If you're a physical silver holder, the crash didn't affect you. Your metal is still worth $95, $100 in the real market. But if you were holding futures contracts with leverage, you were liquidated at $78. You lost 30% while physical holders lost nothing. The kill switch doesn't punish investors. It punishes speculators. And it rewards the banks who were short paper and couldn't deliver physical. The count? 528 million ounces of paper per 113 million ounces of physical. Here's the number that explains everything. The paper to physical ratio. In late January 2026, there were 528 million ounces of open interest in COMEX silver futures. That's the total number of ounces represented by all futures contracts. But COMEX registered vaults only held 113 million ounces of physical silver. That's a ratio of 528 to 113, or 4.67 to 1. For every 1 ounce of physical silver in the vaults, there are 4.67 ounces of paper claims against it. This system works as long as nobody demands delivery, as long as speculators just trade contracts for profit and settle in cash. But when industrial buyers start standing for delivery, when they drain the vaults, the system breaks. In January 2026, that's exactly what happened. Industrial buyers took delivery of 40 million ounces in 3 weeks. The registered inventory dropped from 153 million ounces to 113 million. At that rate, the vaults would be empty in 9 weeks. The banks, who are short futures contracts, would be forced to deliver silver they don't have. Default. Clearinghouse failure. Systemic risk. That's why CME activated the kill switch, not to protect the market, to protect the clearinghouse from the consequences of selling more paper than physical exists. And here's the mechanism. By raising margins to 15%, CME made it prohibitively expensive to hold leveraged long positions. Speculators were forced out. Open interest collapsed. The paper-to-physical ratio dropped from 4.67 to 3.2 in 1 day. Still unsustainable, but no longer immediately terminal. The kill switch bought time, but it didn't solve the problem. Because the physical deficit is real. 835 million ounces of annual demand against 680 million ounces of mine production. That 155 million ounce gap has to come from somewhere. And the somewhere is COMEX vaults, recycling, and scrap. But COMEX vaults are at 30-year lows. Recycling can't scale fast enough, and scrap supply is inelastic. The deficit is structural, unsolvable. And every day, industrial demand removes more physical from the system while paper claims multiply. The kill switch crashed the price. But it didn't create more silver, it just delayed the reckoning. And when the vaults hit zero, when industrial buyers can't get physical at any price, the paper market will collapse entirely. Not 30%, permanently, because you can't deliver what doesn't exist, and margin hikes can't conjure silver out of thin air. The prediction: Wall Street legends flip from bearish to bullish after the crash. Here's where it gets fascinating. 2 of Wall Street's most respected silver analysts predicted the crash, then immediately reversed their positions. Marko Kolanovic, former JP Morgan chief strategist, 20 plus years in the industry, inducted into the Institutional Investor Hall of Fame. Before January 30th, he warned silver would drop 50% within a year. Quote, almost guaranteed to drop from these levels. He was right. Silver dropped 30% in 1 day, but within 48 hours of the crash, Kolanovic flipped bullish, said the correction was overdone, buying opportunity. Peter Brandt, 50-year commodities trading veteran, legendary futures trader. Before January 30th, he compared silver's parabolic rise to the 2011 top. Said a major crash was coming. He was right. But after the crash, he reversed. Said silver had flushed out excess leverage, reset the market, created the setup for the next leg higher. Why the flip? Because they understand the mechanism. The crash was technical, not fundamental. It was forced liquidation driven by margin hikes, not a collapse in demand. And once the leverage is flushed out, once the weak hands are gone, the fundamentals reassert themselves. And the fundamentals are bullish. China export restrictions, 6 years of supply deficits, industrial demand from solar, EVs, AI, semiconductors, COMEX vaults at 30-year lows. These factors didn't change on January 30th. The only thing that changed was the price. And when smart money sees fundamentals unchanged but price crash due to mechanical forced selling, they buy, because they know the crash is temporary. The deficit is permanent. And when the next wave of buying starts, when industrial demand accelerates, when COMEX vaults drain further, the price will go higher. Maybe not to $120, maybe to $150, because the kill switch doesn't solve the underlying problem. It just resets the game. The game is rigged in favor of physical holders. The evidence? Multiple margin hikes within days, not months. Let's document the exact timeline. Because the frequency of margin hikes proves this was coordinated intervention, not routine risk management. December 26th, 2025. CME raises silver margins from $22,000 to $25,000. 13.6% increase. Advisory number 25, 393. December 30th, 2025. CME raises silver margins to $3,500, 30% increase in 4 days. January 7th, 2026. CME switches to percentage-based margins. 9% of notional value. $3,500 at $70 silver. January 28th, 2026. CME raises margins to 11%. $55,000 per contract at $100 silver. January 30th, 2026, CME raises margins to 15% for standard, 16.5% for high risk, $75,000 per contract at $100 silver. That's 5 margin hikes in 35 days. Unprecedented. Compare that to normal market conditions. During stable periods, CME adjusts margins maybe once or twice per year. During volatility, maybe quarterly. 5 hikes in 5 weeks is not risk management. It's market manipulation, and the timing proves intent. Each hike came after silver refused to drop. December 26th, hike. Silver ignored it, climbed to $84. December 30th, hike. Silver ignored it, climbed to $100. January 7th, structural change. Silver ignored it, climbed to $120. January 28th, hike. Silver dropped 5%, then stabilized. January 30th, hike. Combined with Kevin Warsh Federal Reserve nomination announcement, silver collapsed 30%. The pattern is clear. CME kept raising margins until they broke the market, until forced liquidation overwhelmed buying pressure, until the price crashed. This isn't organic price discovery. This is weaponized regulation. And the fact that CME issued 2 more margin hikes on February 2nd, after the crash, 33% for gold, 36% for silver, proves they're not done. They're ensuring that speculative leverage stays suppressed, that paper prices stay controlled. Because if leverage returns, if speculative buying surges again, the banks are vulnerable again. The kill switch has to stay activated. The comparison, 2011, silver crash. Use the same playbook, April 2011. Silver hit $48.70 per ounce, matching the 1980 Hunt Brothers high. Then it crashed 30% in a week. The explanation? Profit taking. Speculative excess. Natural correction. But the mechanism was identical to January 2026. CME raised silver margins 5 times in 2 weeks. May 2nd, margins increased 10%. May 5th, margins increased 10%. May 9th, margins increased 15%. May 12th, margins increased 15%. May 16th, margins increased 10%. 5 hikes in 14 days. Total increase, 84%. The result? Silver dropped from $48 to $33, then to $26 by September, a 54% decline from peak. The official story was that silver was in a bubble, unsustainable. But the mechanics tell a different story. Forced liquidation, margin-driven selling, just like 1980, just like January 2026. The pattern repeats because it works, and it works because futures markets are designed with an embedded kill switch. Margin requirements, CME can change them anytime, without warning, without limit. And when they do, leveraged positions are liquidated, prices crash, banks are protected. The 2011 crash bought Wall Street 15 years. Silver entered a bear market, dropped to $13.70 by March 2020. The short positions were profitable. The paper system survived. But the fundamentals eventually reasserted. Industrial demand grew. Supply deficits accumulated. By January 2026, the pressure was unsustainable. So they pulled the trigger again. Same mechanism, same result. Except this time, the physical disconnect is larger. The supply deficit is deeper. And the industrial demand is irreplaceable. Solar panels can't use copper instead of silver. Semiconductors can't use aluminum. Electric vehicles can't substitute tin. Silver is critical. Inelastic and depleting. The 2011 kill switch bought 15 years. The 2026 kill switch might buy 15 months because the fundamentals are accelerating and margin hikes can't change physics. The trap. How leveraged silver ETFs amplified the crash. ProShares Ultra Silver ETF, ticker AGQ. It's a leveraged fund that seeks 2x the daily performance of silver. When silver goes up 1%, AGQ goes up 2%. When silver goes down 1%, AGQ goes down 2%. It's designed for short-term traders who want amplified exposure. On January 30th, silver futures dropped 30%. AGQ dropped 62% in one day, the worst day in its history. iShares Silver Trust, ticker SLV, the largest physically backed silver ETF, it dropped 31%. Also its worst day ever. Why does this matter? Because these ETFs hold billions in assets, and when prices crash, they trigger forced redemptions, forced selling, and feedback loops. Here's the mechanism. AGQ uses derivatives to achieve 2x leverage. When silver drops sharply, AGQ must rebalance daily to maintain the 2x ratio. That means selling silver futures, forced selling, during the crash, when prices are already plummeting. This creates a feedback loop. Silver drops, AGQ sells. Silver drops more, AGQ sells more. The crash accelerates. Similarly, SLV is backed by physical silver held in vaults. But when the fund's price drops sharply, some investors panic and redeem shares. Those redemptions require SLV to sell physical silver to raise cash. More selling, more downward pressure. This is the hidden fragility of ETFs during crashes. They're forced sellers at the worst possible time. And when millions of retail investors are holding these funds, when they panic and sell simultaneously, the ETF structure amplifies the crash. On January 30th, AGQ's volume was 10x normal. SLV's volume was 6x normal. Retail panic, forced redemptions, mechanical selling. And Wall Street knows this. They understand that crashing silver through margin hikes will trigger ETF liquidation, will amplify the decline, will create more fear. It's not accidental. It's designed. The kill switch doesn't just target futures markets. It targets the entire ecosystem. Futures, ETFs, margin accounts, leveraged funds, anything with forced liquidation mechanisms. And when they're all triggered simultaneously, the crash is catastrophic, 30% in one day. But here's the irony. The physical silver backing SLV didn't disappear. It's still in the vaults. The industrial demand for silver didn't evaporate. It's still strong. The only thing that changed was the price. And the price changed because of mechanical selling, not fundamental deterioration, which means the crash was temporary, a forced reset. And when the panic subsides, when the leveraged positions are liquidated, when the weak hands are gone, the fundamentals reassert and the price recovers, which is exactly what smart money was buying when silver hit $74. The defense. Why this time is different actually matters. Every market crash is followed by the same refrain. This time is different. And it's almost always wrong. The 2000 dot-com bubble, the 2008 housing crisis, the 2020 COVID crash. The pattern is always the same: speculation, euphoria, crash, recovery. But with silver in 2026, there's one factor that genuinely is different: physical supply. In every previous silver crash, 1980, 2011, even 2020, there was no physical shortage. COMEX vaults were full. Industrial demand was stable. The crash was purely financial. Speculative excess being flushed out. But in January 2026, COMEX vaults were at 30-year lows, 113 million ounces. That's less than 2 months of global industrial consumption. And industrial demand is accelerating, not stabilizing. The Silver Institute estimates 2026 industrial demand at 710 million ounces, up 4.4% from 2025. Driven by solar panel installations surging in Asia and Europe, electric vehicle production ramping in China and the US, AI data centers consuming massive amounts of power and requiring silver-based components, semiconductor fabrication expanding to meet chip demand. This demand is inelastic. These industries can't function without silver, and they can't substitute alternatives at scale, which means they will pay higher prices to secure supply. They have no choice. This is different from speculative demand. Speculators leave when prices fall. Industrial buyers stay because they need the metal regardless of price. And here's the critical factor: China's export restrictions. Before January 1st, 2026, China exported approximately 200 million ounces of refined silver annually. After January 1st, that supply is restricted. Licensure required? National security priority. This isn't temporary. This is structural. China is hoarding silver for its own domestic solar, EV, and tech industries. They're not releasing it to global markets, which means the global supply just shrank by 200 million ounces annually. or 24% of total global production. That cannot be replaced. There are no new major silver mines coming online. Existing mines are depleting. Ore grades are declining. Production costs are rising. And recycling, while it helps, only covers about 15% of demand. The math is unsolvable. 835 million ounces of demand, 680 million ounces of mine production, 200 million ounces of Chinese exports removed, 125 million ounces of recycling. Total supply, 805 million ounces. Total demand, 835 million ounces. Deficit, 30 million ounces per year, every year. That deficit has to come from somewhere, and the somewhere is existing above ground inventory, which includes COMEX vaults, which are already at 30-year lows. This is why this time is different actually matters. The previous crashes were financial. This one is physical, and you can't margin call a supply deficit into existence. The warning, what happens when COMEX vaults hit zero? Let me walk you through the end game, the scenario Wall Street doesn't want you to think about. COMEX registered vaults currently hold 113 million ounces. Industrial buyers are taking delivery at approximately 15 million ounces per month. At that rate, the vaults will be empty in 7.5 months. Let's say CME's kill switch slows that rate by half. That buys 15 months. What happens when the vaults hit zero? When industrial buyers show up with futures contracts demanding physical delivery and there's no silver to deliver? Default. Force majeure. Cash settlement at a price determined by COMEX, not the market. This has never happened in silver, but it's happened in other commodities. Palladium in 2001. NYMEX vaults were depleted. Buyers couldn't get physical. Premiums spiked. Spot prices diverged from futures. Eventually, new supply came online. But for months, the market was dysfunctional. Tin in 2021. London Metal Exchange suspended trading. Nickel in 2022. LME canceled trades, declared force majeure. These precedents exist, and they all share one pattern. When physical supply can't meet paper claims, the paper market breaks. Now apply that to silver. Except silver isn't just an industrial metal, it's also a monetary metal, a store of value, held by central banks, sovereign wealth funds, billionaires, retail stackers. When COMEX defaults on physical delivery, the confidence in paper silver evaporates. Futures contracts become worthless. Physical premiums explode. Shanghai silver might trade at $150, while COMEX futures settle at $80. The bifurcation becomes permanent. Two separate markets, paper and physical. And guess which one industrial buyers want? They want physical. They need physical. They'll pay physical premiums, which means COMEX becomes irrelevant. The paper price no longer reflects reality, and Wall Street loses its control, loses its ability to suppress prices through margin hikes and short selling, because you can't deliver paper to a semiconductor fabrication plant. You need metal, real, physical, deliverable silver. And when the vaults are empty, when COMEX can't deliver, the kill switch stops working. Because the kill switch only works on leveraged paper positions. It doesn't work on physical demand. And when physical demand overwhelms paper supply, the system breaks permanently. The truth. Why $74 silver today is a gift for physical buyers. If you're holding physical silver, here's what you need to understand. The crash to $74 on COMEX is artificial. It's driven by margin hikes and forced liquidation. But physical premiums are holding $15, $20 above spot. That means real silver, deliverable silver, is trading at $90 or $95, not $74. The $74 price is a paper illusion, created by Wall Street to shake out weak hands, to protect short-positioned banks, to buy time. But it doesn't reflect physical reality. And if you can buy physical silver at $74 spot plus a $10 premium, you're paying $84. While the physical market in Shanghai is $95. That's an $11 arbitrage, or 13% below real market value. Here's why that's a gift. Because Wall Street's kill switch created a temporary disconnect, crashed paper while physical stayed strong, and that disconnect won't last. Eventually, paper prices converge to physical, because industrial buyers don't care about futures. They care about securing supply. And when they keep buying physical, keep draining COMEX vaults, keep demanding delivery, the paper price has to rise. Otherwise, nobody will sell into COMEX, nobody will deposit physical. The vaults stay empty, and the paper market dies. So Wall Street has a choice. Let paper prices rise to attract physical supply, or watch COMEX become irrelevant. Either way, physical holders win. And here's the strategic positioning. The smart money isn't buying futures with leverage. They're buying physical. Bars, coins, allocated storage, things that can't be margin called, can't be liquidated, can't be settled in cash. When you own physical silver, you're outside the system, outside the kill switch. You're positioned for the end game. when COMEX vaults hit zero, when paper prices diverge permanently from physical, when industrial buyers are bidding $150 for metal they can't get, your physical silver is worth $150, not $74, not $84, $150, because real assets in a supply shortage trade at replacement cost. And if nobody's producing enough new silver to meet demand, the replacement cost is whatever the desperate buyer will pay. That's the end game. That's why $74 is a gift, because it's the last time you'll see paper prices this low while physical supply is this tight. The kill switch worked, it crashed the price, but it didn't create more silver, it just created a buying opportunity for those who understand the difference between paper and physical. The pattern. 4 kill switches, same mechanism, 50 years apart. Let's document the pattern, because once you see it, you can't unsee it. January 7th, 1980. COMEX implements Silver Rule 7, liquidation only, no new long positions. Result, silver crashes 50% in 4 days. March 1980, Hunt Brothers bankrupted, banks saved. May 2011, CME raises silver margins 5 times in 2 weeks, total increase 84%. Result, silver crashes 30% in 1 week, then 54% from peak. Speculators liquidated, banks protected. January 13th, 2026, CME shifts silver margins to percentage-based system, 9% of notional. January 28th, 2026, CME raises margins to 11%. January 30th, 2026, CME raises margins to 15%. Result, silver crashes 30% in 1 day. Speculators liquidated, banks saved. 4 times, same mechanism, same outcome, same beneficiaries. The pattern is deliberate. When silver threatens the banks, when short positions become unmanageable, when physical delivery demands exceed supply, the kill switch activates. Margin hikes, forced liquidation, price crash, crisis averted. Except the crisis isn't averted, it's delayed. Because the underlying problem, the supply deficit, the paper to physical ratio, the industrial demand, it's all still there, unchanged, growing, accelerating. The kill switch is a temporary fix to a permanent problem, and each time they use it, the rebound is faster, stronger, because the fundamentals get tighter. 1980, silver took 30 years to recover to $48. 2011, silver took 10 years to recover to $48. 2026, silver might take 2 years to recover to $120. The timeline compresses because the supply deficit accelerates, because industrial demand is inelastic, because China is hoarding, because COMEX vaults are depleting. The kill switch still works, but its effectiveness is declining. And eventually, they'll activate it and nothing will happen. Because you can't margin call a physical shortage. You can't force liquidate industrial demand. You can only delay and buy time and hope new supply comes online. But it won't, because silver mines take 10 years to develop, and there aren't enough new discoveries, and ore grades are falling, and production costs are rising. The end game is locked in, the only question is timing, and Wall Street just bought themselves another 12-18 months. Maybe. If the physical drain slows, if industrial demand stabilizes, if China reopens exports, none of which is likely. The conclusion, what silver below $74 actually means. Let me bring this full circle. On January 30th, 2026, silver crashed 30% in 1 day, the worst since 1980. The headlines scream, silver bubble bursts, speculators crushed, market corrects. But that's not what happened. What happened is Wall Street activated a kill switch they've used 3 times before. Margin hikes, forced liquidation, mechanical selling. And it worked. The price crashed, the banks were saved, the paper market was reset. But nothing changed about the fundamentals. China's export restrictions, still active. 6-year supply deficit, still growing. Industrial demand from solar, EVs, AI, still accelerating. COMEX registered vaults, still at 30-year lows, 113 million ounces. Physical premiums, still $15, $20 above spot. Paper to physical ratio, still unsustainable. 3-to-1 after the crash. The only thing that changed was the price. And the price changed because of regulation, not reality. Because CME raised margins to protect banks. Because leveraged speculators were forced out. Because ETFs amplified the decline. It's mechanical, technical, temporary. And when you understand that, when you see silver at $74 and physical trading at $90, you understand you're looking at a gift, a disconnect created by Wall Street's desperation to control a market they're losing. Because control requires leverage, requires paper dominance, requires COMEX vaults full of physical backing the futures. And they don't have that anymore. The vaults are nearly empty. The leverage is flushed. The physical buyers aren't leaving. So what happens next? 2 scenarios. Scenario 1, industrial demand slows. China reopens exports. New mine supply comes online. COMEX vaults refill. The paper system stabilizes. Prices stay suppressed. The kill switch worked. This is Wall Street's hope. But it's not likely. Because industrial demand is inelastic. China's restrictions are strategic. New mines take a decade. And COMEX vaults are draining, not filling. Scenario 2. Industrial demand continues. China keeps exports restricted. COMEX vaults drain to zero. Physical premiums explode. Paper prices diverge permanently. The kill switch stops working. This is the probable outcome because the math is unsolvable. 835 million ounces of demand, 680 million ounces of supply, 155 million ounce annual deficit. That deficit comes from COMEX vaults. And in 7-15 months, those vaults are empty. When that happens, when industrial buyers show up with contracts demanding delivery and there's no metal, the paper market breaks, not corrects, breaks, default, force majeure, cash settlement. And physical silver holders become the only source of supply for desperate buyers, bidding whatever it takes to secure metal. $150, $200, $300. That's the end game. That's why Wall Street activated the kill switch. Not to crash silver, to delay the inevitable, to buy time, to flush out leverage before the real crisis hits. And they succeeded. Silver crashed. Speculators were liquidated. But physical holders stayed, industrial buyers stayed, and the deficit stayed. Nothing fundamental changed. Which means the crash isn't the story. The crash is the setup for what comes next. When COMEX vaults hit zero, when the paper market fails, when physical silver becomes the only silver that matters, and $74 becomes the price everyone wishes they'd bought at, while they could, before the kill switch stopped working, and the physical shortage became impossible to hide. If you understand now that $74 silver isn't a crash, it's a reprieve. If you see that Wall Street's margin hikes are a weapon they've used 4 times in 50 years, if you recognize that the paper market is artificial and the physical market is real, then you understand why this moment matters. Subscribe to this channel. Because when COMEX vaults hit zero, when the paper market breaks, when physical premiums diverge to $100 above spot, you'll want to know exactly what happened. And why? And what comes next. Because the kill switch can crash the price, but it can't create silver. And that's the difference between temporary and terminal. Wall Street just chose temporary, but the clock is ticking. And the vaults are draining, and the deficit is permanent. 7 months, maybe 15. Then the system breaks, and physical silver holders inherit the earth. Welcome to the endgame.